In this episode, you will be introduced to the debit and credit system of entering business transactions into the accounting system. When we are using the debit and credit system, it is helpful to use what's called a Taccount. And a Taccount is a tool used to represent an individual general ledger account. And it is a tool that is used to help visualize transactions' effects on account balances. So when we look at a Taccount, the left side of the Taccount is what we call the debit side of the account. And the right side of the Taccount is what we call the credit side. Debits are on the left side, credits are on the right side. In keeping our accounting equation in balance, every time a business transaction occurs and it is recorded into the accounting system, it will require what we call a dual entry method. The dual entry method states that every time a transaction is entered into the accounting system, it will always impact at least two accounts. What this means is that if we record a transaction that causes an asset account balance to increase, something else has to happen in order to keep the equation in balance. That means either an asset also needs to decrease, keeping that side of the equation the same, an asset account increases and decreases, or we need to record an increase to something on this side of the equation. Now, when we look at the different types of accounts, assets, liabilities, and equity, they are going to be affected differently by the debits and credits. Asset accounts always have an increase on the debit side. So if we want to increase an asset account, we need to debit it. If we want to decrease an asset account, we need to credit it. Liabilities, however, have an opposite effect. Credits increase liability accounts, whereas debits decrease a liability account. And finally, over here in equity, overall equity is increased with a credit and decreased with a debit. Now, if this isn't making any sense yet, just bear with me. Give us a little bit more time to work with this. When we expand the equity section, common stock is increased with a credit and decreased with a debit. Dividends is increased with a debit and decreased with a credit. Revenues is increased with a credit and decreased with a debit. Expenses are increased with a debit and decreased with a credit. Recall that in the prior slide I mentioned that overall equity is increased with a credit and decreased with a debit. What we're seeing here as common stock goes up and as revenues go up, those two cause overall equity to increase. They both have credit balances. However, dividends and expenses, the more expenses go up and the more dividends go up, the more overall equity decreases. They have an opposite balance. They both are increased with a debit and decreased with a credit. That is opposite of how we affect a change in a revenue and common stock account. That is because these accounts, revenues and expenses, dividends and stock, are affected differently by debits and credits. So we can look at how using debits and credits causes increases and decreases to accounts by looking at one asset account, cash for example, and see how the account balance is changed by debits and credits. Now, an account balance is the difference between the amount of debits posted to that account and the amount of credits posted to that account. So looking at cash, which is an asset account, recall that debits increase asset accounts and credits decrease asset accounts. So what we're seeing in this cash asset account is that during the course of the accounting period, this account was debited for $30,000 when an owner invested. It was debited when a customer paid for consulting services that had been provided. And it was debited when collection on an account receivable was received. All of these debits reflect cash increases. Thus, all of these debits are increasing the cash account to reflect the impact of the transaction on that asset. Over on this side of the T account, we are seeing that supplies purchased, equipment purchased, rent paid, salaries paid, an account payable liability paid, and cash dividends were paid. All of these are reflected as credits to the cash account, indicating that when each of those transactions was recorded in the accounting system, a credit was posted to the cash asset account, reflecting and causing a decrease to that cash. When we get to the bottom here, we can see that the total debits to cash were $36,100. Those debits are offset by the total credits of $31,300. That results in an excess of debits over credits, leaving $4,800 more on the debit side of the cash account, indicating that cash is left with an ending balance of $4,800 after the effect of all of these business transactions were recorded into this asset account. So expanding on our prior discussion about the journalizing and posting of transactions, the first step in the accounting process is to identify that a transaction occurred from source documents. Then, once that transaction is identified, we need to analyze the transaction to determine what accounts need to be increased or decreased. We do that by identifying whether an asset account, a liability account, or an equity account is increased or decreased. Once we identify what account needs to be changed, we can identify whether that account requires a debit or a credit to effect the change. Once we identify what needs to be increased and decreased, and whether it's a debit or credit, we prepare a journal entry in the general journal, the original book of entry into the accounting system, to tell the accounting system what accounts are increased or decreased with a debit or a credit. And finally, to actually cause the account balances to change, recall account balances are maintained in the general ledger filing cabinet. We would then take each debit and credit from the journal entries in the general journal and post each debit and credit to the appropriate account in the general ledger filing cabinet. This will cause the account balances to increase or decrease appropriately.